Welcome back. Well, given quite active treasury and stock markets lately, thought it might be helpful to revisit the bond market and draw any kind of conclusions we may to as the future trends in the stock markets. So we have here the white line's a 10-year US Treasury bond. This goes back to February of this year. The red line is the 1 year, the 1 month Treasury note, Treasury bill actually. And we have the black line, which is a federal funds rate, interest rates. And we have very much an inverted bond market that still persists since June of last year, actually, where the short term bond, the red line, the 1 month T bill, is higher than the long term 10-year bond. And notice what's happening over the past several months since May, really, of this year. We see a contraction in the spread where we had quite a large gap between the 1 month T bill, which was around 6% at the time, and the 10-year was at 3.7. Well, now they've contracted quite a bit towards the upside in an environment of very high interest rates. Well, I thought it might be helpful to take a look back in history to see when this may have occurred in the past and what followed. The blue area chart, by the way, that's the S&P 500. Now, this is a chart from 2003 through 2007. The 1 month T-bill is the red line. The white line is a 10-year bond. Now, we had a very large gap. Now, this was a positive yield curve, meaning the long-term maturity was above the short-term. And then we saw a massive move up on the short-term yields where the 1 month T-bill approached and actually even crossed above the 10-year bond. The beginning of the inverted bond market, this occurred around 2006, 2007. Again, we noticed the stock market, just a tremendous rally from 2003, around 1,000 S&P 500 up to 1,400 in the course of a couple years. However, as we move forward in time, this starts July of 2007, we see the inverted yield curve where the 1 month bill is above the 10-year bond. Well, at that time, the stock market, the blue area chart in the background, really started to top off and hit its historic highs in 2007 and did not go higher than that for quite a long time after the fact. As the stock market started to turn to the downside, notice what happened. The inverted bond market ended where the red line, the T-bill, crossed back below the 10-year bond, and then the market started to move to the downside. Now, the T-bill moved faster than the 10-year bond did. It moved down actually faster than even the stock market did. Notice the red line moves down first, then the stock market starts to crumble around mid-2008, third quarter 2008. And then finally, the 10-year bond, the white line, really starts to crumble the beginning of 2009. Moving forward in time, we see now an environment of very low interest rates, zero interest rates from 2009 all the way through 2016. The red line is a 1 month T-bill, which moves very closely with interest rates. The shorter the term maturity, like a 1 month T-bill, that moves more closely to federal funds rate. The longer maturity, such as a 10-year bond, that has a delayed effect and it doesn't always move. That moves more in anticipation of long-term future economic conditions. Well, the takeaway from this chart is that when we have zero interest rates, it's almost free to borrow money. And that money is borrowed, it's invested in the stock market, it's invested in businesses, and the stock market obviously goes up. It loves this type of environment. Where S&P 500 around 1,000 went up to 2,200 between 2009 and 2016 with very little interruption along the way. Now notice the 10-year bond was quite strong. There was, a 4% yield at one point, 2010, but over time that actually started to deteriorate. But even though the 10-year bond in 2016 was telling us, well, maybe the economy is not on great footing, the fact of the matter is when you can borrow money almost for free, the 1 month T-bill is at zero, well, the stock market will continue to go up. Fast forward to 2016, now we start to see the red line move up. This moves up as interest rates start to rise and the anticipation of higher interest rates. And this is a pattern we saw before in 2006, where the 1 month T bill moves up and eventually even crosses above the 10-year bond. Notice how the stock market really starts to waver. Now, of course, we had this tremendous market sell off in 2020. That was the COVID crisis. But even before that, we had an inverted bond market. And notice the 10-year bond was at 3%. It fell down to 1.5% a year before the COVID crisis even took place. So the 10-year bond really does forecast future economic conditions. Well, we had the COVID crisis, and then once again, we resumed back to almost zero interest rates. And again, just like in 2015, when we have zero interest rates, stocks are a great buy. We can borrow money basically for free with zero risk, invest that in businesses, invest that in the stock market, and then, of course, the economy recovers. Now we see the 10-year bond move up and the 1 month bond, the 1 month T bill stays flat. The 10-year bond's moving up, not only in anticipation of better economic conditions, but also as a result of the inflation. See, the inflation also sends bond yields up. So it's not only good economic conditions, it's just the anticipation of higher prices. However, those prices may manifest themselves, either through inflation or better economics. Fast forward to 2021, now the stock market, the S&P 500 hits a high right near 4,800, and notice we have quite a wide spread, and the spread even widens in 22. And we see that the 10-year bond goes up, the 1 month T-bill goes up, but then the 1 month T-bill starts to close the gap. Notice how close we were at this point, where the 1 month T-bill is almost at the 10-year bond at this point. Now, the fact of the matter is the stock market really doesn't like a situation with a gap that is closing. The stock market likes a gap that is widening because it shows us that 10-year bond is moving higher than the 1 month T bill in anticipation even better economic conditions in the future. So fast forward to present day now, October 22 through October 23. Now we see the emergence once again of the inverted bond market. Now the 1 year bond actually crossed up prior to the 1 month bond. But nevertheless, we see the red line here is above the 10-year bond, and we have very much an inverted bond market. And this resembles very much the market we saw in 2006 in terms of the bond market, where the 1 month T bill is above the 10-year bond. Of course, the stock market has been strong. It hit highs near 4,600 just a few months ago. And it looks like we're almost back up to those levels again. But the fact of the matter is, this kind of economic condition, or I should say market condition, in the treasury markets is not really conducive for long term growth. Long term growth would be forecasted when we see a 10-year bond yield above the 1 month T bill. And the long term basically the long-term outlook would look a lot better if we saw a widening of the gap. We don't have a widening of the gap. We have a very close relationship between the 1 month T-bill and the 10-year bond, and the 10-year bond is below, obviously the shorter term maturities. So where does this lead us moving forward? Well, of course, history is just a guide. It doesn't guarantee, what happened in the past is going to happen in the future. But the takeaway from this is that moving forward, we should pay a special attention to the 1 month T-bill. If we see the 1 month T-bill cross below the 10-year bond, that will be the same pattern that we saw in 2006, 2007. Of course, if the 10-year bond crosses above the 1 month T-bill, well, that would be a different situation. That would be it would be conducive for long-term economic growth because it would forecast long-term prices would be higher. Now, clearly, the Federal Reserve is not in a position to raise rates anymore. The Fed funds futures tell us that the Federal Reserve is done raising rates. So if we do see a strong 10-year bond emerge from this, it's going to be the result of very strong economic growth. We did have a strong GDP report in the last report. That was 4.9%. We had durable goods more recently, which was not good. Existing homes that was not good. The last jobs market was not really that good either. Inflation is softening though, so it really is a mixed bag of economics. And we're going to be we're going to pay a lot of attention to the economic calendar moving forward to get a better gauge of which way the Federal Reserve and ultimately we think the markets may go. We hope this has been helpful. We look forward to seeing you back soon.